So there is this really old, deeply cynical joke in the aerospace industry.
Oh, I think I know the exact one you're talking about.
Right. It goes, if you want to know how to become a millionaire in the space business, it's actually incredibly simple. You just start as a billionaire and you wait.
Yeah, exactly.
Yeah.
It's funny because it's painfully true. Historically, space has just been this ultimate incinerator of capital.
Because you are dealing with physics that absolutely refuse to compromise. You have hardware that, you can't just send a mechanic to repair once it leaves the atmosphere.
Right. And the development timelines, I mean, they stretch across decades. It's an industry where gravity is quite literally trying to pull your investment down to zero every single second.
Every single second. But for a long time, the only entities that could actually absorb that level of financial risk were national governments.
Sure, like NASA or the Department of Defense.
But over the last decade or so, that paradigm has shifted entirely. We saw this massive, just a flood of private capital rushing into commercial space companies.
And if you are putting your capital on the line in the public markets today, you have to navigate an environment where the hype, and there is a lot of hype, constantly outpaces the actual engineering reality.
Which brings us to our mission for this deep dive. Today, we are putting on our most skeptical lenses. We want you, the listener, to step into the shoes of a public market investor on the hunt for a high-conviction short candidate.
We want to find a company whose narrative is, completely detached from its financial and operational reality.
Right, and we are going to see if we can build a bulletproof thesis to basically bet against it.
And our target for this exercise is Rocket Lab.
Rocket Lab.
Yeah. They are one of the most prominent, frequently discussed players in the commercial space sector right now, which makes them just a prime candidate for a stress test.
But before we put them under the microscope, we really have to establish the strict rules of engagement for this analysis.
Oh, absolutely.
First and foremost, we are entirely ignoring valuation. I want to be super clear on that. Whether the market is pricing them at $1 billion, $10 billion, or $50 billion is completely irrelevant to our exercise today.
Right. We aren't debating multiples today. We are looking purely at the mechanics of the business itself.
Exactly. We are specifically hunting for structural rot. And that means we're looking for 4 distinct pillars of failure.
4 pillars, right. The first one is deteriorating unit economics. Like, are they just bleeding cash on every core transaction to buy market share?
Right. And pillar 2 is an eroding competitive moat. Is the launch industry commoditizing around them?
Third would be management red flags, which, encompasses aggressive accounting tricks, value-destructive acquisitions, poor governance, all that stuff.
And the 4th pillar is structural headwinds, things that threaten the long-term viability of their massive growth initiatives.
And we have to make a pledge for this analysis. We are going to be ruthless, sure, but we will maintain strict intellectual honesty throughout.
Because management teams, they are paid to spin a beautiful story. They're going to put the best possible light on everything.
Right. So we're going to aggressively challenge that spin using their raw data. But, and this is really the most important part, we will not force a bearish conclusion if the facts don't back it up.
Exactly. If we dig down and find solid bedrock, we are going to tell you it is solid bedrock. We aren't going to manufacture a short thesis just for the sake of being contrarian on a podcast or, well, in a deep dive.
That level of discipline is essential for an investor because in the capital markets, a highly researched, defensible realization that a short thesis actually fails is often just as valuable as finding one that works.
It prevents you from stepping in front of a freight train.
Precisely, it stops you from making a disastrous bet.
Okay, so let's get into the financials, starting with the absolute foundation, which is unit economics.
Let's do it.
If I am building a short thesis against a rocket company, my fundamental assumption is that launch services are just a commodity. It's a delivery service, right? Like FedEx, but pointing up.
That's the classic bear argument, yeah.
So in a market characterized by heavy capital requirements and, frankly, a graveyard full of bankrupt competitors, logic dictates this should be a brutal race to the bottom. Everyone is trying to claim market share.
Right, which means they must be slashing prices.
Exactly. Rocket Lab must be compressing their margins just to keep their launch pads active.
And that is the most common intuitive assumption to make. Because if you look at terrestrial transportation, freight shipping, commercial trucking, it almost always devolves into a price war.
Right. Whoever is cheapest wins.
But space doesn't behave like terrestrial logistics. Not at all. When we actually open up Rocket Lab's data on their small launch vehicle, the Electron rocket, the pricing trajectory actively defies the commoditization narrative.
Okay, so what does the data actually show? Let's look at their average selling price, or ASP.
Yeah, so if your thesis is right, that ASP should be trending down year over year as new competitors enter the market.
I would expect it to be plummeting, honestly.
But the data shows the exact opposite. Let's track it chronologically. In their early commercial days, going back a few years, they were selling an Electron launch for sub $5 million.
Okay, under 5 million.
Right. But that was essentially introductory pricing. It was designed to prove the vehicle's reliability and secure those early anchor customers. But as we move forward, that price doesn't drop. It scales aggressively.
How aggressively?
The ASP moves to $7.5 million.
Oh, wow, that's a big jump.
Yeah. And then by the fourth quarter of 2023, their backlog reflected an ASP of $8.1 million.
Wait, it went up again.
It did. By the fourth quarter of 2024, it ticked up again to $8.2 million. And looking at their calendar year 2025 commentary, management explicitly projected that ASP would materially expand even further.
Okay, hold on. They are jacking up prices by over 60% from their early days, and customers are just accepting it.
They are paying it without blinking.
But that defies basic supply and demand. Unless there is some mechanism I am totally missing here. Like, why wouldn't a satellite operator just walk across the street to a competitor? Or better yet, just buy a really cheap slot on a SpaceX Falcon 9 rideshare mission.
Right, because SpaceX is famous for offering incredibly cheap per kilogram pricing.
Exactly. If you bundle your satellite with 50 others on a Falcon 9, it's pennies on the dollar compared to an $8 million dedicated launch.
You've hit on the exact mechanism that gives Rocket Lab pricing power. It comes down to two things: schedule certainty and orbital precision.
Okay, break that down for me.
Think of a SpaceX rideshare like taking a public bus. It is incredibly cheap, absolutely. But the bus leaves when the bus is full, and it goes to the exact neighborhood the primary payload chooses.
So you're just along for the ride.
Exactly. If you are a commercial satellite operator and you need to get to a very specific orbital inclination, say you need to monitor a specific latitude on Earth for a major agricultural client, a rideshare bus might drop you off thousands of miles away from where you actually need to be.
And then what? You have to use your satellite's own onboard thruster fuel to maneuver to your actual destination.
Yes, which takes months. And it shortens the operational lifespan of a satellite that cost you tens of millions to build in the first place.
Because you used all your station-keeping fuel just getting to the starting line.
Precisely. Or, even worse, the primary payload on that rideshare gets delayed.
Oh, so if the big satellite isn't ready, the rocket doesn't launch.
Right, which means your little satellite sits in a warehouse for 8 months. And if your business model relies on generating revenue from that satellite today, an 8-month delay costs you vastly more than the $3 million premium Rocket Lab is charging.
Okay, I see. So Electron is basically a dedicated charter jet.
Exactly. You dictate the exact launch schedule, and you dictate the exact orbital insertion point. Because Rocket Lab has proven they can deliver that bespoke service reliably, the price elasticity of their customer base is incredibly low.
They don't care about the price tag because time is money.
Time to orbit is literally money. They will gladly pay the $8.2 million.
Okay, I understand the pricing power side of the equation, but raising prices doesn't guarantee a healthy business.
True.
Because if your underlying costs are spiraling out of control faster than your price hikes, your unit economics are still a total disaster. And building rockets is notoriously expensive.
It's basically burning cash.
So let's look at their gross margins. Are they actually turning a profit on these $8.2 million launches, or does it cost them $10 million to build the thing?
Well, let's look at the financial journey because it's a really stark one. If you were looking to short Rocket Lab back in 2021, you had phenomenal ammunition.
Oh, really?
Oh, yeah. For the full year 2021, their launch services non-GAAP gross margins were deeply negative. We are talking negative 15%.
Negative 15%. So at that moment in time, it literally cost them more to build, fuel, and launch the rocket than the customer was paying them.
Exactly. Every time a rocket went up, they lost money.
That is the classic tech bubble punchline. You know, we lose money on every unit we ship, but we'll make it up in volume. It rarely works in software, and it seems mathematically impossible in heavy hardware. So how did they convince the market they weren't just bleeding to death?
By actually executing on the volume. If we fast forward from that negative 15% in 2021, the progression is staggering.
Walk me through it.
By the fourth quarter of 2023, their GAAP gross margin had turned positive, hitting 25.8%, with non-GAAP at 32.3%.
That's a massive swing.
And it gets better. By the fourth quarter of 2025, their total non-GAAP gross margin reached a highly profitable 44.3%.
Wait, 44% on a physical rocket?
Yes, they transformed a structurally unprofitable transaction into a massive gross profit engine.
I need you to explain the mechanics of that, because you cannot just magically make aerospace-grade aluminum and carbon composite 40% cheaper overnight. How do you flip a hardware margin that violently?
The mechanism is a concept called overhead absorption.
Okay, overhead absorption.
Right. And to really understand it, we have to look at the physical infrastructure required to operate a launch company. To launch even a single rocket, you have to maintain a sprawling, highly specialized footprint.
You can't just launch from a parking lot.
Exactly. Rocket Lab owns and operates Launch Complex 1 in New Zealand, which actually features 2 separate pads, and Launch Complex 2 in Virginia.
Which means they aren't just paying for the rocket itself.
Exactly. They are paying for the radar tracking infrastructure. They are paying the salaries of a full mission control staff. They are maintaining massive cryogenic fluid management systems.
Like the liquid oxygen tanks.
Right, the tanks and the plumbing that handle liquid oxygen, which requires constant, expensive maintenance due to thermal cycling. Freezing and thawing metal degrades it quickly.
Okay, so they have this massive fixed cost base.
And in 2021, their launch cadence was very low. They were hampered by COVID-19 supply chain issues, and they had an anomaly that grounded them for weeks. So when you only launch a handful of rockets a year, the entire financial weight of that massive ground infrastructure is divided among a very small number of revenue events.
Oh, I see. It just crushes your per unit margin. The infrastructure is essentially a fixed anchor dragging down the profitability of the vehicle.
But as they systematically scaled up their operations, pushing toward a target cadence of 24 launches a year, that dynamic inverted.
Because the cost of the launch pad doesn't change.
Exactly. The cost of maintaining the radar dish or the launch mount doesn't double just because you launch twice as often. Wow. Every incremental launch absorbs a larger fraction of that fixed overhead.
So the fixed costs are spread out over more revenue.
Suddenly, what was a massive liability on the balance sheet transforms into profound operating leverage. The $8.2 million ASP drops straight to the bottom line because the fixed costs are already paid for by the first few launches of that quarter.
Okay, that explains the financial leverage beautifully. But there is a massive engineering component to this margin story that we really need to scrutinize.
You're talking about reusability.
Yes, reusability. A massive part of management's pitch to Wall Street regarding their path to profitability was that they were going to reuse the rockets. They promised they were going to catch falling rocket boosters out of the sky using a helicopter, refurbish them, and fly them again.
It was a very bold pitch.
And frankly, if we are hunting for a short thesis, broken promises are the best place to look. From an engineering perspective, this helicopter idea seemed wildly overambitious. Let's do a reality check. Did they actually pull off the helicopter catches?
We absolutely need to highlight this because it represents a major pivot. In May 2022, during a mission that was aptly named There and Back Again, they attempted this highly publicized mid-air capture.
Okay, what happened?
The Electron first stage re-entered the atmosphere, deployed its parachutes, and this customized Sikorsky helicopter swooped in and successfully hooked the parachute line.
Wait, they actually caught it.
They caught it.
Oh, wow.
But almost immediately upon taking the load, the helicopter pilot experienced unexpected aerodynamic characteristics. A rocket booster dangling beneath the helicopter acts like a massive pendulum.
It's swinging around.
Right, and the load dynamics exceeded the safety parameters they had established. So the pilot made the correct call and released the booster, allowing it to splash down into the ocean.
Okay, so operationally, it was a failure.
Correct.
They spent millions engineering the cinematic capability. They promised investors it would revolutionize their margins. And when they actually tried it, physics got in the way and they just had to drop it in the ocean. If I am writing a bear case, I am putting that in bold text. Management failed to engineer reusability as promised.
And if you lock your analysis entirely into that single afternoon in May 2022, you could absolutely write that bear case.
It looks really bad.
It does. But if we are evaluating the fundamental health of the business, we have to look at how management reacted to that failure. This is where we see a crucial difference between a company driven by ego and a company driven by unit economics.
What did they do?
Well, instead of stubbornly pouring tens of millions of dollars into engineering a better helicopter hook or risking pilot lives to force this cinematic vision to work, they analyzed the data from the booster they dropped in the water.
But dropping a precision-machined aerospace vehicle into saltwater is generally considered a catastrophic event for the hardware, right? Saltwater and complex turbopumps do not mix well, like, at all.
That was the assumption. Everyone assumed it would be ruined. But when Rocket Lab fished that booster out of the ocean, they realized the thermal protection systems they had designed to survive the heat of reentry actually did a remarkable job of sealing and protecting the internal components from the ocean water.
Oh, it was basically waterproofed by accident.
Exactly. So they pivoted. They completely abandoned the helicopter program and leaned fully into marine recovery.
Just scooping it out of the water?
Yep. They designed highly specialized vessels to retrieve the boosters immediately after splashdown. They engineered rapid purging systems to flush out any corrosive salt water from the Rutherford engines before it could cause structural degradation.
So they basically said, why risk a helicopter crash when we can just give the rocket a really good freshwater bath the second it hits the ocean?
Precisely. It is significantly less flashy. You aren't going to get viral YouTube videos of a boat pulling a wet metal tube out of the Pacific.
No, definitely not as cool.
But the financials do not care about viral videos. They care about the cost of goods sold. And the marine recovery pivot worked flawlessly from a financial perspective.
Did they actually fly one again?
Better than that. By the third quarter of 2023, Rocket Lab successfully took a Rutherford engine that had been submerged in the ocean, refurbished it, put it on a test stand, and successfully refired it.
Okay, but how does that actually impact the bottom line, though? Is cleaning a saltwater-soaked engine actually that much cheaper than just printing a new one?
It is, and it's because of the production bottleneck. The Rutherford engine is largely 3D printed, which is innovative, absolutely. But 3D printing 9 engines for every single first stage takes a lot of time, and it occupies really expensive additive manufacturing machines.
So it's an opportunity cost.
Exactly. By recovering and flying marine-recovered engines, they drastically reduce the pressure on their factory floor. They don't have to build a brand new first stage from scratch every single time.
Which means they can launch more often with the same factory footprint.
Yes. It lowers production costs, increases their overall launch capacity without massive capital expenditure, and directly drives that margin expansion we discussed earlier.
Wow.
Management promised reusability would drive margin. The method changed, but the financial outcome was delivered exactly as promised.
All right, so our quest for deteriorating unit economics has basically hit a brick wall. They possess real pricing power, their fixed cost leverage is expanding their gross margins into the mid-40s, and they successfully navigated a pragmatic pivot on reusability that actually works.
The economics are solid.
So we have to move our microscope. Let's attack the second pillar of our short thesis, the competitive moat and industry headwinds.
Let's do it.
Because even if Rocket Lab's internal economics are solid today, they still operate in a macro environment. And I have a theory about this industry. Tell me if this analogy holds up. Isn't the small launch industry fundamentally identical to the commercial airline industry?
How do you mean?
Well, historically, commercial airlines are a terrible place to park capital. They are highly cyclical, insanely capital intensive, and entirely dependent on volatile fuel prices.
All true.
And customers have absolute zero brand loyalty. When you or I buy a flight, we just sort by the cheapest ticket on a travel website. We don't care if it's Delta or United as long as it's cheap.
Right. It's a pure commodity.
And inevitably, a swarm of low-cost carriers enters the market, undercuts everyone, and ruins the unit economics for all the legacy players. Now, a few years ago, there were literally dozens of aspirational small launch companies promising to build cheaper, faster rockets. Isn't Rocket Lab just sitting there waiting to be undercut by a fleet of budget space airlines?
It is a brilliant analogy, and frankly, that exact thesis was the core of many short reports just a few years ago.
So is it real fear?
Oh, absolutely. The market was flooded with venture capital money, and there were over 100 paper companies promising to build small launch vehicles. But to build our thesis today, we have to look at the market reality of the present, not the projections of 2021.
And what is the reality today?
The reality is that the influx of cheap competitors never materialized. Instead, we are witnessing a massive, brutal wave of industry consolidation and bankruptcy.
So the budget airlines all went out of business before they even bought planes.
Exactly. We have to understand the transition from the zero interest rate policy, or ZIRP era, to a normalized cost of capital. In 2021, money was free. You could raise $50 million with a charismatic founder and a slick PowerPoint presentation.
It's just a cool render of a rocket.
Literally. But aerospace operates on uncompromising timelines. When the macroeconomic environment tightened and investors demanded actual physical progress instead of financial models, the slideware and vaporware companies simply evaporated.
They ran out of cash.
They ran out of cash before they ever bent a single piece of metal.
But hold on, there were companies that actually bent metal and flew, right? It wasn't just PowerPoint presentations across the board.
Yes, and that is where Rocket Lab's moat truly reveals itself. Look at Virgin Orbit.
Richard Branson's company.
Right, they were backed by Richard Branson. They had a wildly innovative concept of air-launching a rocket from beneath a modified Boeing 747, and they actually achieved orbit multiple times.
So they were a real competitor.
They were. But the operational complexity of their system, combined with a lower launch cadence and high fixed costs, led to cash burn they just couldn't sustain. They filed for bankruptcy.
Wow. Any others?
Astra. They went public, struggled immensely with reliability, suffered multiple high-profile launch failures, and saw their stock price essentially go to zero before being taken private for pennies. So the swarm of competitors didn't undercut Rocket Lab. They largely destroyed themselves.
Okay, but if we are going to maintain our intellectual honesty here, we cannot just point at Rocket Lab's dead competitors and declare Rocket Lab invincible.
No, definitely not.
We have to rigorously examine Rocket Lab's own failures. Because they haven't been perfect. If their competitive moat is built on reliability, we need to know what happens when they fail. And they have failed, haven't they?
They absolutely have. And a proper bear case must detail these setbacks. As of the end of 2025, while they had achieved 75 successful orbital missions, they had also suffered 3 total failures on customer launches.
3 total failures.
We need to look at the mechanisms of those failures. In July 2020, during their 13th flight, they suffered an anomaly during the second stage burn.
What went wrong?
The root cause was traced to a single, faulty electrical connection within a battery pack that somehow escaped testing. It caused a total loss of power to the electric turbopumps.
Wait, so a single bad wire caused the entire payload to be lost?
Correct. The rocket couldn't maintain thrust. Then, in May 2021, they suffered another second stage anomaly. This time, an issue within the engine computer system corrupted the telemetry data.
No, the computer got confused.
Yeah, and it caused the engine's thrust vector control system to command emergency shutdown mid-flight.
Thanks.
And most recently, in September 2023, during their 41st mission, a complex electrical arc occurred within a high-voltage power supply, operating in the unique vacuum conditions of space.
A short circuit in space.
Basically, resulting in a total loss of power to the second stage. And in all 3 instances, the customer payloads were completely destroyed.
Those are catastrophic events. I mean, if you are a satellite manufacturer, you just spent 3 years and tens of millions of dollars building a bespoke piece of hardware, and a high-voltage arc turns it into a fireball over the Pacific Ocean.
It's devastating for the customer.
So if your whole value proposition is being the reliable charter jet, 3 fatal crashes sounds like a massive breach in the castle walls. How did these failures not permanently shatter customer trust and just destroy their business model overnight?
Because you have to evaluate failure through the specific lens of the aerospace industry. In this sector, everyone from the investors to the customers understands that space is inherently hostile and extremely difficult.
The joke about the billionaire again?
Exactly. The true test of an aerospace company's moat is not the absolute absence of failure, because physics guarantees you will eventually fail, but rather the speed and rigorousness of your resilience.
It's how you bounce back.
It is entirely about how quickly you can diagnose the issue, engineer a fix, and confidently return to flight.
Okay, so how fast did they recover? Because usually when a rocket explodes, there are months of government investigations, congressional hearings, and just endless red tape.
Look at the data from the 2020 and 2021 failures. In both cases, because Rocket Lab builds almost all of their components in-house and has unprecedented access to high-fidelity telemetry data, they were able to pinpoint the exact root cause within days.
Within days.
Days. They engineered the hardware and software fixes, presented the data to the Federal Aviation Administration, and received official FAA clearance to resume launches in less than 3 weeks.
Less than 3 weeks. A 3-week turnaround from a fiery explosion to putting another rocket on the pad. That practically defies gravity and aerospace timelines.
It is historically unprecedented, and that speed is the actual moat. It signals something vital to the customer base. It tells them that even when the absolute worst-case scenario materializes, Rocket Lab has the internal engineering depth to solve it immediately. They aren't reliant on a massive web of third-party subcontractors pointing fingers at each other for 6 months while the customer waits.
Right, there's no blame game because they own the whole stack.
That resilience breeds intense schedule certainty, which is exactly why customers continue to pay that rising ASP.
I see. So it's not just that they launch, it's that they can adapt instantly. Are there other examples of that agility translating directly to revenue aside from crash recoveries?
Let's look at the Black Sky mission in the second quarter of 2022. Black Sky operates a constellation of Earth observation satellites.
Okay, like spy cameras for commercial use.
Right. And right as geopolitical conflict was escalating in Eastern Europe, Black Sky realized they needed immediate continuous satellite coverage over that specific region. That meant they couldn't just launch into any generic orbit. They needed a highly specific orbital inclination change.
And changing orbital inclinations is mathematically incredibly complex, right? You have to recalculate the entire trajectory.
Which changes the safety corridor for the launch.
Which means you need entirely new regulatory licenses from the FAA.
Exactly. It usually takes a year of planning just to execute that shift. Black Sky came to Rocket Lab with this urgent request. Rocket Lab recalculated the trajectory, reprogrammed the flight computers, secured the new regulatory licensing, integrated the payloads, and launched the mission successfully in exactly 45 days.
Wait, 45 days?
45 days from request to orbit. You simply cannot get that capability from a rideshare mission where you were a secondary passenger.
No, SpaceX isn't moving their whole bus route just for you.
And you certainly can't get it from a startup that is struggling to figure out their basic supply chain. That is why the airline analogy fundamentally breaks down. When your competitors are going bankrupt and you are the only entity capable of providing bespoke, on-demand, 45-day turnaround orbital insertion, your competitive moat is not eroding.
It's expanding.
It is widening into an ocean.
All right, so the product is highly profitable, the margin structure is sound, and the competitive moat is aggressively repelling invaders. Let's pivot our investigation to the third pillar, the management team, governance, and capital allocation.
This is where things usually get interesting in short reports.
Because history is full of companies that had great products but were just hollowed out from the inside by fraudulent accounting, executive hubris, or reckless empire building. If the rot isn't in the rocket, maybe it's in the boardroom.
This is where we need to switch from engineering analysis to forensic accounting.
Good, because I have a massive red flag I want to throw on the table right now. Rocket Lab did not take the traditional, rigorous, initial public offering route to enter the public markets.
No, they didn't.
They went public via a special purpose acquisition company called Vector Acquisition Corporation back in 2021. And let's be honest, the SPAC boom of 2021 was an absolute breeding ground for terrible governance, wildly inflated financial projections, and aggressive revenue recognition designed to basically trick retail investors.
It was the Wild West.
It really was. So when we dig into their SEC filings, what kind of accounting skeletons are we finding from that SPAC era?
You are totally right to be highly skeptical of the SPAC origin. If we pull up their initial filings, specifically the audit for the year 2020 as they were preparing for the public transition, the auditors explicitly flagged material weaknesses in internal control over financial reporting.
Bingo. A material weakness in financial reporting is the ultimate smoke alarm for an investor. What specifically were the auditors flagging there?
The material weaknesses primarily related to a lack of formal processes, specifically management's review of schedules and complex reconciliations, a general insufficiency of dedicated accounting resources, inadequate oversight of third-party valuation specialists, and, most critically, a lack of controls over the segregation of duties.
Okay, segregation of duties is a massive issue. For anyone listening who is unfamiliar, that essentially means the person who has the authority to authorize a payment shouldn't be the same person who physically cuts the check and reconciles the ledger.
Right, you need checks and balances.
If you don't separate those duties, it is incredibly easy for someone to misappropriate funds or manipulate the numbers. So, do we have our short thesis right here? Is the accounting fundamentally untrustworthy?
We have to contextualize the red flag. What the auditors found was essentially a group of brilliant aerospace engineers operating a private startup who suddenly realized they were about to become a heavily scrutinized public company.
They didn't have a giant corporate accounting department yet.
Exactly. These are incredibly common growing pains for a highly technical startup. The decisive factor for our short thesis is not whether the weakness existed in 2020, but how management responded to it. Did they sweep it under the rug or did they fix it?
And what does the subsequent data show?
Following the SPAC transaction, They immediately implemented comprehensive remediation plans. They deployed the capital they raised to hire robust, experienced accounting teams. They instituted proper JAP-compliant software architectures to handle that segregation of duties.
So they built the corporate infrastructure.
Yes, and most importantly, if we look closely at how they actually accounted for the SPAC transaction itself, it reveals a profound level of conservatism.
Walk me through the mechanics of that. How do you account for a SPAC conservatively?
Under standard accounting rules, specifically ASC 805, which governs business combinations, the transaction was treated as a reverse recapitalization. Legacy Rocket Lab was treated as the accounting acquirer. But here's the critical part. They recorded the transaction with zero goodwill or other intangible assets.
Zero goodwill. Explain why the absence of goodwill is so important here for the bear case.
Well, in many of the most fraudulent SPAC deals of that era, the management teams used the complex merger mechanics to basically invent massive amounts of goodwill, which is an intangible asset, to artificially inflate the size of their balance sheet.
Make the company look drastically more valuable on paper than it actually was in reality?
Exactly.
Yeah.
Rocket Lab actively chose not to do that. They recorded the net assets of the Vector SPAC at their historical cost. It was a very clean, incredibly conservative accounting treatment that deliberately avoided inflating their book value.
Okay, I'll concede that they cleaned up their initial internal controls and didn't play SPAC games. But what about the ongoing day-to-day revenue recognition? Building a complex satellite bus for the government can take 3 to 4 years.
A long cycle, yeah.
Are they being aggressive? Like, are they booking revenue on day one before they have actually done the hard engineering work?
We need to bifurcate their revenue streams to analyze this properly. Let's start with the launch business. For launch services, they utilize what is called point-in-time revenue recognition.
Point in time.
This is the ultimate standard of conservatism. They do not recognize a single dollar of launch revenue until the intentional ignition of the rocket engines actually occurs.
Wait, really? If the rocket is sitting on the pad, fully fueled, and an anomaly causes a scrub 5 seconds before liftoff?
They do not claim the revenue. The service has to be physically delivered and off the ground.
That is undeniably clean. But what about the space systems side? The division where they build components and entire spacecraft, because that takes years.
For long-term space systems contracts, such as their large-scale constellation builds, they use, over time, percentage of completion accounting.
Which means?
This is entirely standard JAP compliance for long-term manufacturing. The revenue is only recognized proportionally as they hit highly specific, contractually agreed-upon engineering milestones, and they have to actually incur the costs associated with them to book it.
So they can't just say, we signed a contract, book $50 million.
No, absolutely not. We are actively hunting for aggressive pull-forwards or accounting tricks, but the filings show a rigorous adherence to conservative GAAP principles.
All right, if the accounting is solid, we have to look at how they are spending the cash. Let's scrutinize their mergers and acquisitions track record, because since going public, Rocket Lab has gone on an absolute buying spree.
They've bought quite a few companies.
They acquired Sinclair Interplanetary Advanced Solutions, Inc., Planetary Systems Corporation, Geest, Mynaric, Motive Space Systems, and Solero. I mean, this looks like classic executive empire building.
Just buying revenue.
Right, buying up random companies just to inflate your top-line revenue numbers to appease Wall Street, regardless of whether the businesses actually fit together or make sense.
Empire building is a very real threat to shareholder value, so we must analyze the specific deals.
Let's dive deep into the Solero acquisition. Solero is a manufacturer of space-grade solar cells, right?
Correct.
When Rocket Lab acquired them, there was a glaring immediate red flag buried in the financials.
You were referring to the fourth quarter of 2022.
Yes. Rocket Lab had to record a $9.4 million measurement period adjustment, specifically a provision for a contract loss directly related to Solero's legacy business.
That's right.
And nearly $10 million loss provision on a company you literally just acquired. And it gets worse. When they integrated Solero, it dragged Rocket Lab's overall space systems gross margins down to an abysmal 10%.
It plummeted, yeah.
That is the exact definition of value destruction. You buy a distressed asset, you immediately take a massive write-down, and it poisons your own internal margins. If you are a short seller, this is your smoking gun. That management is completely reckless with capital.
It undeniably looks terrible on the surface, but to maintain our intellectual honesty, we must evaluate the timeline and the execution after the purchase. Management didn't hide from this at all.
They didn't.
No, the CEO and the executive team were extremely transparent on their earnings calls. They openly acknowledged that they bought Solero knowing it was saddled with a $150 million legacy backlog of structurally low-margin, poorly priced contracts.
So why buy it at all? Why intentionally infect your clean balance sheet with bad contracts?
Because they needed the physical asset. It was the price of entry to acquire the fundamental manufacturing infrastructure for space solar panels. And management made a very specific, measurable promise to the market.
What was the promise?
They stated they would churn through that legacy backlog, take the short-term hit, and systematically improve Solero's gross margins to 30% by the end of 2024.
And did they execute? Because a promise is just a promise until it actually hits the P&L.
They executed flawlessly. By the time we hit 2025, they had achieved that 30% margin target.
Really? How did they just aggressively raise prices, or did they fundamentally fix the manufacturing?
They fixed the underlying technology. They introduced high-efficiency IMM technology.
IM.
It stands for Inverted Metamorphic Multi-Junction Solar Cells. Without getting too deep into the semiconductor physics, IMM technology allows you to manufacture solar cells that are significantly lighter while producing more power.
And in space, mass is everything.
Mass is the most expensive commodity in existence. By improving the power-to-weight ratio and implementing rigorous yield enhancements on the factory floor, they turned a distressed, low-margin asset into a highly profitable internal capability.
Okay, but we still need to address the broader pattern here. Even if they fix Solero, why buy all those other companies? Sinclair, ASI, PSC, Minaric, I call it empire building. You need to explain to me why this isn't just an executive team trying to buy their way to a bigger market cap.
Because it isn't empire building at all. It is a masterclass in ruthless vertical integration. To understand why, you have to look at the structural bottleneck of the entire space industry.
Which is?
The supply chain.
Explain that.
Let's look at the components they bought. They acquired Sinclair to own the manufacturing of reaction wheels.
What's a reaction wheel?
A reaction wheel is a motorized flywheel that spins inside a satellite. By changing the speed of the wheel, it uses the conservation of angular momentum to physically rotate the spacecraft in the frictionless environment of space without having to use chemical thrusters.
So it's how you steer.
Exactly. It is an absolutely critical component. Then they acquired Advanced Solutions, Inc. to own flight software. They acquired GEAS to own the optical sensors. They acquired Minaric to secure laser communications technology.
Laser communications.
Yeah, which allows satellites to instantly transmit massive amounts of data to each other in orbit using lasers, rather than bouncing radio waves down to Earth and back up again.
Okay, so they basically bought the catalog of parts required to build a satellite.
Exactly.
Right.
Before these acquisitions, if Rocket Lab wanted to build a satellite, they were essentially a general contractor. They had to wait in line behind massive defense primes like Lockheed Martin or Boeing to buy a star tracker or a reaction wheel from a third-party vendor.
And Lockheed gets priority.
Always. And when global supply chains seized up or a vendor prioritized a larger client, Rocket Lab's production line would just grind to a halt.
I see. So vertical integration is a defensive maneuver to protect their timelines.
It is highly defensive, yes. By owning the vendors, Rocket Lab completely insulated themselves from the supply chain shocks that bankrupted their competitors. But it's also highly offensive from a margin perspective.
How so?
When Rocket Lab bids on a massive mega-constellation contract today, for instance, the $143 million contract they won to build 17 spacecraft buses for Globalstar, they aren't outsourcing the components. They are packing those 17 spacecraft with their own Sinclair reaction wheels, their own Solero solar panels, and their own flight software.
They're capturing the margin at every single level of the bill of materials.
Every single level.
It's the Henry Ford model. Don't just build the car, own the steel mill and the rubber plantation too.
Exactly right.
So let's summarize where we are. We've stress-tested 3 pillars. Unit economics. They're expanding, with significant pricing power and fixed cost leverage.
Check.
Competitive moat. It is widening aggressively as competitors die off, and Rocket Lab demonstrates unmatched operational agility.
Check.
Management and governance. We found clean, conservative JAP accounting, a fully remediated material weakness, and an M&A strategy that successfully executed complex vertical integration without inflating goodwill.
The oxygen for our short thesis is almost entirely depleted at this point. It really is.
Which brings us to the final and perhaps most critical pillar. Section 4. Future growth initiatives.
This is the big one.
We have established that their past execution is highly competent. But history is littered with companies that executed perfectly on their core product only to incinerate themselves by overreaching on their next big bet.
Absolutely.
We need to evaluate if Rocket Lab's future plans are destined to be a black hole for capital.
And this is undoubtedly the highest risk area of the business.
The absolute centerpiece of this risk is the Neutron rocket. Rocket Lab mastered the small launch vehicle with Electron, we established that, but now they're pouring roughly $250 million of capital into developing Neutron.
Which is a massive vehicle.
It's a medium-lift, fully reusable launch vehicle designed to directly compete with SpaceX's Falcon 9. Developing a rocket capable of lifting 13,000 kilograms to orbit is exponentially harder than building one that lifts 300 kilograms.
It's a totally different ballgame.
And we already have evidence of failure here. In the first quarter of 2024, the CEO explicitly admitted to investors that Neutron was facing delays caused by developmental gremlins, pushing the first flight to no earlier than mid-2025.
Yes, the schedule slipped.
Isn't this a classic case of executive hubris, biting off vastly more than they can chew and setting fire to shareholder capital in the process while chasing Elon Musk?
The timeline delays are real, and in aerospace, delays always consume capital. To understand the gremlins, you have to appreciate the massive engineering leap they're taking. Neutron isn't just a bigger Electron.
It's not just scaled up.
No, it uses a completely new engine architecture called Archimedes, which operates on an oxidizer-rich, staged combustion cycle.
Okay, that sounds complicated.
It's incredibly complex. It is designed to be highly reusable, which means dealing with immense thermal stresses and resonance frequencies that you just don't encounter on smaller, expendable engines. Furthermore, Neutron is built entirely out of advanced carbon composites, and curing carbon composite structures at a 7-meter diameter requires massive, highly complex tooling.
So the engineering risk is massive. Does this validate the capital black hole theory?
If they were operating recklessly, yes, it would. But to assess their capital allocation regarding Neutron, we have to look at how they mitigate that risk. And we actually have a prime example of brilliant, opportunistic capital allocation that directly de-risk the Neutron program.
Oh, what did they do?
We talked earlier about the bankruptcy of Virgin Orbit.
Right, the air launch guys.
When Virgin Orbit collapsed, they had a massive, fully equipped, 144,000 square foot aerospace manufacturing facility located in Long Beach, California. Rocket Lab swooped into the bankruptcy proceedings and purchased the entire facility, including all the specialized machinery, for $16.1 million.
$16.1 million. What was the actual value of those assets?
Rocket Lab's internal estimates secured roughly $100 million in value from that single purchase.
You're kidding.
No. It comprised $20 million in leasehold improvements to the facility itself and $80 million in high-end, extremely difficult-to-procure aerospace manufacturing equipment.
So they basically bought a turnkey rocket factory for pennies on the dollar.
Exactly. And the real value isn't just in the monetary discount, though that's huge, it's in the time.
Time to market.
If Rocket Lab had to order custom CNC milling machines, specialized 3D printers, and massive autoclave curing ovens for Neutron's carbon fiber structures, they would be waiting years due to global supply chain lead times.
You can't just order a rocket curing oven on Amazon.
Right. By buying the Virgin Orbit factory, they instantly acquired that equipment. It drastically accelerated Neutron's production timeline and mitigated tens of millions in capital expenditure that they would have otherwise had to spend out of pocket. That is the exact opposite of a capital black hole. That is highly disciplined, highly opportunistic capital allocation.
Okay, that definitely mitigates the launch risk for Neutron. But what about the other side of the growth strategy? The Space Systems division.
The satellite side.
Right. We know they integrated the acquisitions, but are they actually scaling this business, or are they just selling a few solar panels to university science projects? Are they capturing real, durable market share?
The financial data points to hypergrowth. If you look at the Space Systems revenue prior to the SPAC transaction, it was generating just a few $1 million a year. It was an afterthought to the launch business.
A side hustle.
But for the full year 2024, Space Systems revenue exploded to a staggering $310.8 million.
$310 million.
Yes. It has transitioned into the primary revenue engine of the entire company.
But we talked earlier about the blended margins. Even after fixing Solero, the overall Space Systems margins hover in the 40% range. Is it a problem that their primary growth engine is structurally lower margin than their emergent component business?
We really have to segment how that business operates to understand the margin profile. The merchant component side of the business, where they sell a reaction wheel or a star tracker to a third-party prime contractor, is incredibly lucrative. Those components command gross margins in the 60 to 70% range because they are highly proprietary and mission critical.
So what pulls the blended average down to the 40s?
The massive multi-million-dollar satellite bus contracts. When Rocket Lab is contracted to build the entire spacecraft from top to bottom, they are dealing with massive scale and complex system integration, which inherently carries lower percentage gross margins.
But the absolute dollars are huge.
Exactly. The sheer volume of absolute gross profit dollars generated by those contracts is staggering. 40% of a $140 million contract is a massive amount of cash.
And who are these contracts with? Are these sticky, reliable customers, or are they volatile commercial startups that might go bankrupt next year?
They are the stickiest, highest-tier customers on the planet. Look at the contract wins over the last few years. Beyond the $143 million commercial contract for Globalstar we discussed, they have deeply penetrated the national security apparatus.
The government.
Yes, they secured massive awards from the Space Development Agency, or SDA, to build out the military's next-generation orbital data transport layer.
Wow.
They were selected as a key partner alongside Raytheon to support the Department of Defense's Golden Dome space-based interceptor program. And they secured a record-breaking contract to support the highly classified MACH-TB hypersonic test program.
So they aren't just selling parts, they are deeply embedded in the most demanding, highest priority national security space architectures of our generation.
Correct. And when you become an integrated prime contractor for the Department of Defense, that revenue is incredibly durable. The barriers to entry for those specific programs are nearly insurmountable for a new competitor.
All right. Let's take a deep breath and unpack absolutely everything we have uncovered today.
It's a lot of ground.
It is. We started this exercise with a very clear mission to systematically and ruthlessly hunt for the 4 pillars of a short thesis against Rocket Lab.
Right.
We scrutinized the mechanics of their unit economics. We stress-tested their competitive moat against industry bankruptcies and their own catastrophic launch failures. We dug into the accounting of their SPAC transition and the margins of their acquisitions, and we evaluated the capital risks of their future growth initiatives.
You looked under every rock.
We promised the listener ruthless intellectual honesty. So now it is time to face the data and make a definitive call. Based on absolutely everything we have analyzed today, I need you to formally articulate the short thesis.
Well, if we are adhering strictly to the principle of intellectual honesty, I must explicitly state the conclusion the data demands. The short thesis completely falls apart.
Completely.
Based on the fundamental mechanics of this business, there is absolutely no credible, defensible short thesis to be made here.
Walk me through the synthesis. Why does the bear case fail across the board?
Well, we set out looking for deteriorating unit economics, expecting a commodity price war. Instead, we found a company wielding immense pricing power, driving their average selling price up to $8.2 million, while simultaneously leveraging fixed cost absorption and pragmatic marine recovery to take gross margins from negative 15% to over 44%.
Okay, and the moat?
We looked for an eroding competitive moat in a crowded market. Instead, we found a macro environment where competitors are suffocating under the realities of capital constraints, while Rocket Lab leverages an unprecedented ability to recover from failure in 3 weeks. They've established themselves as a monopolistic provider of rapid, bespoke orbital access.
What about the internal rot? Management and capital allocation.
We searched for management fraud, aggressive SPAC accounting, and value-destructive empire building. We found the exact opposite. We found highly conservative gap accounting with zero goodwill inflation, a fully remediated material weakness, and an executive team that operates with a ruthless focus on execution.
And the acquisitions.
Their M&A strategy wasn't vanity. It was a highly strategic, margin-accretive, vertical integration playbook that permanently insulated them from global supply chain shocks.
And finally, the future risk.
We looked for capital black holes and failing growth initiatives. Instead, we found a space systems division scaling hyper-aggressively to over $310 million, securing Tier 1 national security contracts. And we found a massive neutron development program that was brilliantly de-risked by acquiring Virgin Orbit's manufacturing infrastructure for pennies on the dollar.
So, to force a bearish narrative here would be to completely abandon reality.
You'd be making it up.
We would have to manufacture a conclusion that the evidence actively refutes. And if you are putting your capital on the line, a rigorously defended no thesis is vastly more valuable than a forced, intellectually dishonest bear case. It saves you from stepping in front of a company that is executing flawlessly in one of the most unforgiving environments governed by physics.
Exactly. Recognizing a bulletproof execution story is the ultimate safeguard of capital.
Which brings us to a final provocative thought I want to leave you with today. We've spent this entire time talking about rockets, marine recovery, and satellite components. But I want you to step back and look at the macro evolution of this business.
The big picture.
Right. When a company successfully transitions from providing a single, highly specialized service like launching a rocket to owning the entire underlying infrastructure layer of an industry.
Which is what they're doing.
When they build the satellites in their own factory, write the flight software, manufacture the solar panels and the reaction wheels, and then launch the entire package on their own rockets from a launch pad they own and operate, they stop being a mere service provider.
They transcend the category entirely. They become a platform.
Think about the implications of that. We went looking for microfractures in a company's foundation. But what we actually found was a company that is systematically vertically integrating the entire space economy. They don't just own the delivery trucks. They own the factories that build the cargo, the software that routes it, and the roads it travels on.
It's an end-to-end monopoly.
Think about what happens to the balance of power in the commercial and military space sectors when the company holding the keys to orbit also owns the exclusive supply chain for everything operating up there.
It raises a profound question about the future of the industry. Who will truly control the infrastructure of the next frontier?
Thank you for joining us on this deep dive.